My next guest acknowledges nosebleed, quote-unquote, valuations overall, but says Facebook at $70 billion isn't as crazy as it sounds. Dave McClure is the founding partner of the venture capital firm 500 Startups. He's also managed early-stage investments for Founders Fund and ran the Facebook Fund, which was a joint venture by Founders Fund, Excel, and Facebook. Dave, welcome to Bloomberg West. I've heard so much about you. I'm glad to have you here. So first of all, nosebleed valuations, you think they're out there, but Facebook isn't one of them. Explain that.
So I think the difference maybe between now and 10 years ago is a lot of the companies that are about to go public or already are on the secondary markets are actually making a lot of money, both in terms of revenue and in terms of profit. And Facebook in particular has an audience of 600 million users on the way to 700 million users. And actually, the per user economics on Facebook are not really that great. They're going to get a lot better. And Facebook's already making billions of dollars. So it's really, maybe not as crazy a story as most people think. And Facebook in a few years is going to be probably one of the most profitable companies on the planet.
Now, we're hearing a lot of these stories about Facebook investors and employees trying to sell their shares now ahead of an IPO. Do you see potentially a mass exodus from Facebook before the IPO?
No, I think it's the same story for a lot of Silicon Valley employees at companies that are very valuable. They're probably diversifying 10 to 20% of their holdings and getting some liquidity now. I think that the majority of Facebook employees are probably holding on to their stock for a while. But for them, after being locked up for maybe 3 or 4 years or even longer, they're probably getting some liquidity on that and buying a home or two in the Bay Area.
And those homes may be getting more expensive if all these Facebook people keep buying them. Dave, do you think that they should be selling right now, or should they hang on?
I mean, I was at PayPal back when we went public, and I sold a little bit of our stock on the way up. I held most of it. I think that, still there's going to be opportunities for people to sell some of their stock and take a little bit off the table, and that's not unusual. And it's also not a short signal. I think they'll still hold the majority of their stake for quite a while.
I guess what's unusual, though, is that, number one, they can sell in a private market before an IPO, and they've got valuations in a private market that seem to be post-IPO valuations.
Yeah, I think that's really just due to the optimism for Facebook. I think you're seeing improvements in Facebook's economic model and business model all over the place. They're making more money from advertising. Facebook Credits is starting to work. They just launched the Deals platform. So there's a lot of places for Facebook to make money, and I think the optimism and potential for Facebook around social commerce is what's driving valuations higher and higher.
So it's obviously not just Facebook, but Twitter, Zynga, Groupon. Those are kind of the big four we always talk about. Of those four companies, which do you think is the biggest question mark in terms of whether it will be able to deliver on these giant numbers?
Well, I think probably of those that you mentioned, Twitter is the one that doesn't necessarily have huge revenues today. In terms of potential, there's a lot of users of Twitter that are out there. One that you didn't mention, I think Living Social, is one that isn't on the radar for a lot of people, but actually is also generating a very large sum of money. So the real story that I think is being missed by people, yes, there's speculative valuations, they're very high, but there's actually a lot of companies making billions of dollars today, and I think that's what's driving people's interest in the internet.
Now, how is this trickling down to you investing at the seed stage? I mean, I assume it's getting more and more expensive.
A little bit. So valuations are up across the board, both at the early stage and at the later stage. I think what's different is that most of the big VCs are still swinging for the fences, trying to hit home runs, trying to find the next Facebook, the next Google, the next, Living Social or Twitter or Groupon. A lot of what's happening in the angel market, though, is we're really aiming for singles and doubles, and we're betting on companies that are lying on top of all those other companies. So in a lot of sense, we're kind of betting on electricity, and we think electricity is going to be big, and that companies and products that use electricity are also going to have a bright future. So for those of us in the lower levels, maybe it's not quite as crazy as those playing in the big leagues.
Dave, is there some hope that maybe one of them might become more of a platform, or is the idea really just additional companies that will benefit from the existing platforms of Facebook, Twitter, or whatever?
I think, at least at 500 Startups, our philosophy is that we're not trying to be Barry Bonds or Albert Lopez. We're trying to be Ichiro. Or I often use the analogy of we're trying to be the Oakland A's. So we believe in kind of hitting singles and doubles and using metrics and building real businesses that make money. In this environment, Facebook and Twitter and these other platforms lift all boats. And so for us, search and social and mobile platforms are really a story about customer acquisition, and monetization is getting better and better. We're working in our second second deal in China right now. We're looking at taking a bunch of folks down to Brazil next week. So there's really a pretty big growth story that's happening on the internet all over the place. Even here in the U.S., my kids are using iPads. My grandmother using, the web and Skype video to talk to her kids. I'm very bullish, obviously, about what's going on in the web. There's a few people that are betting speculatively on things that aren't going to work, but overall, I think people are a lot smarter than they were 10 years ago.
First of all, 500 is the name of the company, not the goal, right?
We're only at 120 so far, so still got a ways to go. The goal is to make money. The goal is to make money and help startups succeed.
So I want to talk to you, ask a question from one of our Twitter users, Justin DeLay, who wanted to ask you, how do you balance opportunities in the Facebook ecosystem with the risk of running up against Facebook's monetization strategy?
Well, I think that was a risk maybe a few years ago where it was unclear where Facebook was making money. That's less and less of a concern now that Facebook is pretty obviously making money in advertising and making money in Facebook credits. Maybe it's a little bit of a question mark whether deals is going to be a big area for Facebook. But again, I think they're going to be a great source for generating money for both themselves and for the third-party ecosystem. So with most of these platforms, the question is, what is the platform making money on so I know I'm not going to get stomped on? 3 years ago, that was a little bit unclear. Now I don't think that's as much of an issue for Facebook.
Dave, okay, 500 startups isn't the goal. Making a little bit of money isn't the goal. But you said you were, what, 120 some companies?
Yeah, we have 120.
Okay.
I'm sorry?
120 what? 129, did you say?
We've 120 companies that we've invested in so far. Our goal with the first fund is to invest in about 200 of them at incubation and seed. We expect that maybe 50 of them will make it to Series A, probably about 25 at Series B, and then we'll maybe have 10 larger exits and maybe 20 or 30 smaller exits.
Why don't you just pick the 10 good companies now and concentrate your money and get better returns?
Yeah, because I'm not that good. I think most venture capitalists really aren't able to pick the winners in the first inning. Maybe Excel and Benchmark are that good, but I don't think I'm that good. So we're trying to take advantage of portfolio theory, have a large diversified strategy, and then let the companies prove themselves out. So we make a lot of small bets initially, and then we double down on the stuff that's working after we see traction.
So there's a lot of money in Silicon Valley right now. Nobody would argue with that. And whether you think there's a bubble or not a bubble, everyone I talk to says the cycle will repeat itself eventually, whether it's a year from now, 3 years from now. The money will dry up for a little while.
And then what happens with those companies? I don't think the money's ever going to dry up. Sequoia was betting that the money was going to dry up after 2008, and a year later we had plenty of money again. So I don't think the money's going to dry up. I think we've also learned a lot of lessons from 99, 2000, and then also, more recently from 3 years ago. Strangely enough, entrepreneurs are getting a little bit smarter. We're not spending millions of dollars on servers, on software, on bandwidth, on marketing campaigns, unless there's profitable customers to be had. And I think a lot of the philosophies of lean startup that have been promoted by Eric Ries and Steve Blank and other folks, people are learning that they're not really having to spend a lot of money to build companies, at least the initial stages of them. And so instead of making one bet at 5 million, we can make 10 bets at 500,000, or in our case, maybe 100 bets at 50,000. And 60 or 70 of those might not work, but 30 probably will. And then we can spend a lot more efficiently, larger amounts of money once we see those companies working.
All right, Dave McClure, 500 startups. We could talk to you about so much more, but you'll just have to come back. Thanks so much for joining us on Bloomberg West.